in general, like really hitting a 10x or even 100x in crypto, it is possible, but it's more like a lottery ticket, because there's going to be one coin that does that, and there's going to be 20 or 30 coins which are going to dump 50, 60, 70% from your entry. So as a new investor, I would definitely not try and search for the overnight success in crypto, because it's usually not the wisest path.
This episode is sponsored by Saxo Markets.
Welcome to the Investing Insiders podcast, where we help you achieve financial well-being by making smarter money decisions. I'm Brianne.
And I'm Antonia.
And in today's episode, we'll be digging into the world of cryptocurrency, how it works, and whether it's worth investing in. Joining us today is Markus Lutz, an experienced crypto investor and founder of Beyond the Market. Markus, welcome to the show.
Thanks so much for having me.
Amazing. Well, this is a really interesting area to kind of dig into. And I suppose before we get into the nitty-gritty, can you just give us a brief overview of what cryptocurrency is and how it actually works?
I would love to. So cryptocurrency is basically a fully digital and global payment infrastructure at the end of the day. So basically it is running on a blockchain. And probably a lot of you have heard the word blockchain, because blockchain is used in many different instances. But in a way, I always try to picture it visually to better understand what it really is. And the blockchain is a chain of connected blocks to each other, and each block contains information. That information is fully transparent and unchangeable. So basically, as soon as each block is closed, which happens after a certain amount of transactions, then that block becomes fully encrypted, and retrospectively there is no change possible anymore. And interestingly, it is a super transparent system. It is a blockchain is fully transparent. So basically, you as a user can understand every single transaction that has ever happened on a blockchain. And these cryptocurrencies, in a way, are transacted on the blockchain, and there's just so much to talk about.
Markus, can I just ask you something? Yes. If I'm someone who has never invested in cryptocurrency before, but I'm sort of curious about it and I'm thinking about it, do I need to actually understand how this blockchain thing works in order to go ahead and invest in it? Is it important?
No, it's actually not important to understand it. I just find the tech fascinating, and I think if you understand it, it helps to weather the storm a bit more, right? I think probably everyone has heard that crypto is super volatile. So if you understand that there's actually logic and long-term viability in the system, then you have a much bigger conviction of holding through the storm. Right, so that's why I think it has an additional benefit. It's not necessary, of course. You can just invest and set and forget. But when there's a lot of terrible news in the market, then it's often wise to think about the long-term structure and picture, and that's exactly when I think it makes sense to understand what a cryptocurrency is a bit more. And we can also picture it in a simpler way, because in a way, each blockchain, there are many blockchains, but let's just focus on one. There's going to be one cryptocurrency, which is going to be the payment or the transaction currency on that blockchain. So let's say on the Bitcoin blockchain, you pay in Bitcoin for every transaction. And the interesting thing here is that it's fully digital and global. So every transaction happens in an instant. On most blockchains, there are slower and faster ones, of course. And you have low costs. And it is available 24/7. And that's something that I personally have experienced firsthand when I lived in the US, and I'm from Germany. So I had to transact a lot of money internationally sometimes, right? Like when I moved to the US, I had to buy furniture and had to, get money for the deposit for my apartment and stuff. So I used crypto for that because it comes at a fraction of the cost and it's instant and 24/7. And that is really interesting because it's sort of many call it an alternative financial system. And it is, but it's of course still super small and in infant stages compared to, the traditional financial system. But in a way, it's just a way to transact and to transact online and fully digital. And it has evolved since then.
So, how long have you been involved with crypto?
I've been in crypto since 2020 and have invested, for the first time, more money just before the big crash. So that was not ideal. The big crash in 2021 and 2022. So I've been, in the space for roughly 5 to 6 years.
Okay. And what sort of took you into that space?
What drew me into the space was the tremendous return potential. I've been in financial markets for a much longer period of time, roughly since 2015. So basically investing and trading. And I have seen the tremendous rally from Bitcoin in 2018, where Bitcoin rallied from $1,000, $2,000 to $20,000, so a 10x. And I stayed on the sidelines completely for the whole time and thought, wow, that's spectacular. And then it drew me in, and I sort of started small, as probably most investors would do, and then gradually just increased my knowledge, what it actually is, and also increased my investment.
How much investing experience did you have before exploring crypto? Was this something completely new for you in terms of investing, or did you have a solid portfolio before exploring it?
I would say I did have a solid portfolio beforehand, primarily in stocks. I've always been interested in owning companies and understanding what they do, and just basically participating in the long-term wealth creation, right? Always thinking if I put $1 or £1 into this company, there's actually people that make sure that my pound is going to be worth more in the future, or my share at the end of the day. So I did have, some investing background, but that was all self-taught. So like I never had any kind of official certification, or also in my role as a controller, basically within like the finance department of a manufacturing company, I did not have a lot of touch points with investing.
And with how volatile cryptocurrencies can be, were there any risks that put you off, or were you kind of in a position where you just thought, okay, I'm just going to go for this and see what happens?
So I think the latter. So I sort of said, okay, like the long-term potential is huge, but I have to be prepared to take a serious hit, and that's exactly what happened. Like I think at first I put in like 20K roughly, and it like within a couple months it was worth only 10K. So like a 50% haircut, and that was difficult at the time. And I thought, okay, like I'm the stupidest person ever falling for this. But eventually, with understanding more, and that's exactly, to your earlier question, if you understand that there's a use case behind, and that in the future, like we're moving towards a more digital and more efficient financial economy as well, that's when I understood, okay, like in the long term, in a 5-year time horizon, there's no way my investments are going to be worth less than what I initially put in. And so it was sort of like learning on the go, I would say, like sort of like experiencing the volatility firsthand, and then sort of adapting to it, and like diving more into it rather than withdrawing from it, I would say.
So what percentage of your portfolio would you say you've got in crypto at the moment?
I would say roughly 50% at the moment.
50. Okay, so would you say that's quite high?
I would say that's quite high, and that's not something that I'm recommending to others to start with, right? I think a solid allocation of, depending on the market timing, right? Since crypto is super volatile, I would recommend maybe 10 to 20%. That's what I'm recommending. I'm definitely recommending more than some traditional banks who have started to sort of see cryptocurrency as an asset class like commodities, to have like a minor allocation of like 3 to 5%. I think there's definitely more potential here, because when we look at the total investment size, or the market size that crypto has, it's still so small. That's why I think exponential returns are still possible. And that's why I'm recommending, like, I would say 10 to 20% for most investors. And just like to recap my thought here, if we look at the total market size for crypto, it's $3 trillion at the moment. And that sounds like a lot, but it's like compared to other asset classes, so small. Gold, for example, has 3.31 trillion at the moment market size. The US stock market is at 60 trillion. And US residential or any kind of residential markets, of course, above 100 trillion. So like we're still like a 10 to 20x away from gold and the stock market. Not saying that crypto is worth that much, but there are so much, new developments, etc., that I do think that there is definitely, a 5x in terms of market cap potential within the next 5 to 10 years. So
there's a lot of like different cryptos to choose from. How important is that choice?
I would say very important. I think for most people, the wisest decision is just to own Bitcoin, right? Bitcoin is often referred to as the digital gold. And whether or not you agree with that, it does have similar characteristics, right? It has a super low coin inflation rate. Basically, the total amount of Bitcoin is limited to 21 million based on the mathematical setup of the blockchain. And at the moment, we're at 19.5 million, which are in circulation. And of course, a lot of them are already lost since people, lost access to their wallet. But in general, it is a scarce resource, and it is universally more or less accepted by now. And that's what it compares, and that's why, in my opinion, it compares decently well to gold. Right, the inherent value of an ounce of gold, right, which currently runs at $4,500, is equally difficult to estimate versus how much inherent value does one Bitcoin have. So I do see like similarities here, and from market cap, gold is still 10x away from crypto as a whole, and 15x away from Bitcoin.
Okay, so you've mentioned this volatility with crypto. And you mentioned something just then about timing. A lot of what we do at Investing Insiders is geared towards buy and hold investors. And we encourage people not to try and time the market, because it's actually a very difficult thing to do and you need a lot of experience to do it. And often when inexperienced people try and do it, it can go wrong. So the messaging with crypto, presumably, is it different? Is it that timing the market is actually really important? And if timing the market is important, how do people go about doing that?
So that's a great question. I think if you first start out with crypto, there's nothing really wrong with dollar cost averaging into the market. However, I do think if I look at historical returns, there is an advantage to be had when trying to time the market. And it doesn't have to be complex. I think what really matters in crypto is managing your emotions, right? The more volatility you have, the more important managing your emotions is. And that's why if you just want to time the market, you could just use a fear and greed index. And whenever there's a lot of fear in the market, right, and fear and greed indexes you find everywhere, like you find on, CNN, you find on all sorts of platforms. If you just buy whenever there's a lot of fear in the market, and you either hold or you sell during massive euphoria, then you can actually have a much better return in crypto. And that, of course, also depends on, what kind of coins you choose. If you just stick with Bitcoin or with even more volatile coins like altcoins, then sort of managing your investment more actively becomes very important, in my opinion, especially with altcoins. From a Bitcoin perspective, I think there's really nothing wrong with dollar cost averaging, because the volatility also gets smaller, right? It's still big, but it does get smaller. And if you always dollar cost average into the market, you're going to be fine, right? Over the past 5 years, Bitcoin has returned on average, I think, 38% per year. And so if you just dollar cost average, you're still going to be massively up on your investment.
So, Markus, just explain to people who don't know what dollar cost averaging is.
Okay, of course. Dollar cost averaging means that you set aside a certain amount of dollars, pounds, euros, whatever, per month that you can afford to put into savings that you don't need for your daily living. And you invest that same amount every single month. Like a lot of brokers these days, a lot of brokers offer this automatically, right? So let's say you have 500 pounds to spare every month. So you can just basically, like, you just invest it automatically, no matter what the market does, where the price is. You don't care about that, right? Like, it's just passive. You don't have to think about it. And that's definitely a great way of starting also crypto investing, because if you worry about the market too much, you're gonna be shaken out by volatility. If you think about whenever the stock market takes a 10% hit, usually crypto takes a 30+% hit. And if you think about that all the time, you're gonna be scared. And by having this automation, it also forces you to buy. It forces you to buy into the fear, which is very powerful, in my opinion, because that's what most investors get wrong.
So if I came to you and I had just, received an inheritance and I had a lump sum of money and I was going, okay, I'm going to give this crypto thing a go, would you suggest, if I was brand new to it, would you suggest putting that in as dollar cost averaging, so putting it in monthly in smaller increments?
Mm-hmm. Yeah, it's definitely wise to dollar cost average into the market, whether that is with monthly savings or also with a bigger lump sum, right? To not be exposed to the market entirely, because otherwise you're gonna suffer a lot if there's gonna be a heavy market downturn, and you're just gonna you diversify your risk, right? And that's what dollar cost averaging is about. So also when my clients or friends and family come to me with like a lump sum, I always recommend that they split it up into chunks, and you can just put in chunks equally based on a time period or based on how the market is developing, right? Then we're getting into more advanced sort of investing techniques, like if then scenarios, right? If Bitcoin is down whatever 30%, then I'm going to invest this. If it's down further, then I invest this. You can get infinitely complex with these things, but it's usually easier for most people to just make it simple and just decide on it once what you're going to do, and then put the action plan into place. Like, for example, if you want to invest, let's say $20,000, and you then I would recommend splitting that into 6 equally big chunks over 6 months, and then you just basically you set that up in your broker app, and then you're free to go about your day, and you have made that big decision and don't have to worry about it.
This episode of the Investing Insiders podcast is sponsored by Saxo Markets. Saxo provides access to a broad range of global assets through a sophisticated trading platform. You can trade US stocks from as little as $1 per trade and UK stocks from $3 per trade. Please remember that all investing involves risk. The value of your investments can go down as well as up, and you could get back less than you invest. Terms and conditions apply. Visit Saxo Markets to learn more.
I think it would be really valuable to hear what your transition was like into the crypto space. So how much research did you do beforehand, and what did you do to kind of keep on top of the news and updates about the cryptocurrencies you were invested in?
Okay, let's first start with with sort of my journey into crypto. When first venturing into crypto, in my opinion, it's important to maybe have a quick look at the Wikipedia article of what Bitcoin is and what generally a cryptocurrency is, so you have a rough understanding. But there are also there's an infinitely deep rabbit hole you can go down that is not necessarily wise, I think, in the beginning to start, because it overwhelms you. And in the end, the most important thing is, in my opinion, to invest, right? Like that is the key difference that your life will, or your future self will be thankful for. So it's most important, I think, to understand the basic, understand what risk there is. I think that's key, especially when it comes to the broker choice. For example, in crypto, there's a lot of non-KYC apps, and I don't want to get too technical, but basically a lot of offshore brokers who offer beautiful bonuses. If you join, you get $500 of this, and then this airdrop and this coin. And this is usually very alluring, but it's not wise to get into that. So I would basically start by starting at the Wikipedia article or watching a 5-minute video about what Bitcoin is. And then you're going to already know what's most important, in my opinion. And then the key should be to start small, start investing. So when you first have that urge of investing, you should start, because otherwise you're going to put it off and forget about it. So starting small, and I think the best, or not the best, but the most important decision in the beginning is really to select the right broker, because there's a lot of shady business going around in crypto. Especially if you look into more deeper resources like Reddit, or you watch some YouTube videos from crypto people, and they have, affiliate programs with brokers that are offshore most often, because that's what pays the best commission. And there I would be really careful. So I would stick always to regulated brokers. Like I personally always use Coinbase, because it is, and I'm not affiliated in any way with them. I just want to say that, because it's the major broker that is regulated on the New York Stock Exchange, with transparent earnings, transparent assets. So there's nothing that is safer than that, in my opinion. And this is probably the most important decision when starting out.
So you've mentioned that you need to have a strong stomach for volatility. And volatility, just for those that don't know, is the ups and downs of value of the coin. So in your experience, how long does it take on average for market downturns to recover when it comes to something like Bitcoin?
So usually in crypto, we have historically seen sort of a 4-year cycle. And if you sort of start venturing into crypto, you're definitely going to hear that a lot. Basically, it aligns with sort of a Bitcoin halving event. And I don't want to get too much into the weeds, because it's not important, I think, for beginner investors. But historically speaking, there is a 4-year cycle, basically from the peak down to the lows, and then up again. And usually the downturn usually happens for a year, more or less, where the market structure is bearish, and basically meaning the market dumps and prices fall, and then usually there's like one year with like medium gains, small sideways price action, and then there are like 1 to 2 years of really explosive price action, where Bitcoin really pulls like the triple digit percentages in a year, and many altcoins like do much more.
So with the stock market, we say to people, you put your money in for 5 years, because that's enough to ride out any volatility. Does that still stand with Bitcoin then?
I would completely agree. Yeah, in my opinion, there's no way that Bitcoin is going to be worth less in 5 years than it is today.
So, in your personal experience, what do you know your 5-year returns?
Yeah, the 5-year returns I had are roughly 48%.
Okay, so you've almost doubled.
Yeah, and the important thing is like to lose everything in the correction, right? Like even some of the biggest coins, like they're gonna drop 80% during a bear market, if not more, and that's difficult to stomach if you didn't make the right choices of selling during euphoria or whatever. So like that would be the key difference I'm making to my friends, family, and clients, is that, in crypto, it's important to take profits, like to take some chips off the table when things are going well, because when things are going well, it usually means really well in crypto. So it's almost too good to be true. And I can also tell you a personal example. I did invest in sort of an AI coin, super small market cap, and I just put in $1,000, and it rallied all the way up to $10,000. So a 10x within, I would say, 2 months. So it was absolutely ridiculous. And I didn't sell a single coin, and I wrote it back down to $1,000. And so that was a terrible mistake. But in hindsight, it taught me a lot. Like in crypto, especially depending on where you are on the risk curve within crypto, you should definitely look at taking profits when markets are volatile.
Okay. So that's a major difference between crypto and sort of equity investing, because with sort of stock market, we would sort of say the longer you're in, the better, and just keep everything where it is and just hold. This kind of veers into timing a little bit now. So how is the new person supposed to navigate that?
That's a very good question, because most investors have not experienced that, right? And there's a lot of hesitation also, right? When you first are confronted with cryptocurrency, right? I also experienced that when I first talked to new clients. Like what's the value of a Bitcoin? Like it's worth, like it costs $90,000 just to own one, and what do I have? Like there's no inherent value. That's always the concern, right? And then when volatility kicks in, then they're either proven wrong or right, depending on where the volatility goes. But I think for new investors, my best recommendation would be that if you say you don't want to maximize returns, you just want to have a passive exposure to crypto and you don't want to have too much exposure to the volatility, which I think is best for most people, then I would truly recommend sticking with primarily Bitcoin and just dollar cost averaging into the market. And maybe like if there's a major drop in the market, then maybe just adding a bit more to it, to your dollar cost average, if you're comfortable with that. Otherwise, I think from a long-term perspective, there's nothing wrong with dollar cost averaging. And I think that's probably the easiest way to start in the beginning, because I also don't want to make it too complicated, right? Complication is the enemy of execution, and execution is what matters most, in my opinion. So you just want to keep it simple, just dollar cost average into Bitcoin, and there's nothing I think that you're going to do wrong over the long term.
So one of the things that can be quite striking when people talk about Bitcoin and cryptocurrency generally are the large returns that some people do experience and some are just advertised. Obviously, with your experience with the AI coin, you had like a 10x return within 2 months. If you were to hear that in sort of equity investing, that kind of news is a little bit too good to be true. And it's something that we would recommend people steer clear of, because, you know, that kind of get rich quick, almost overnight success type of thing isn't necessarily the most sustainable. For somebody venturing into the cryptocurrency space, how do they navigate claims like that? Like, how do you know if something is, you know, really going to generate that level of income? And is it worth getting yourself into, or should you kind of just hold out and see?
So in my opinion, if you ever hear, like as a new investor, if you ever hear someone say that or claim that they have like a very good strike rate of finding coins like this, I would always stay clear of, you know, those people, because in general, like really hitting a 10x or even 100x in crypto, it is possible, but it's more like a lottery ticket, because there's going to be one coin that does that, and there's going to be 20 or 30 coins which are going to dump 50, 60, 70% from your entry. So as a new investor, I would definitely not try and search for the overnight success in crypto, because it's usually not the wisest path. And you as a beginner are definitely not going to find the 10x coin. There's like literally probably 1 in 10,000 is going to be the chance of you finding that coin. And then having also the emotional discipline of selling is also difficult. I can tell you from my own experience. So I think, from my perspective, what I always try to preach is that in crypto, the returns are still exponential compared to any other asset class. So I would try to always recommend sort of stifling your personal greed of trying to, you know, make millions overnight, or, you know, 10x your money overnight, because you're still going to be super fine with a 20 to 30% annual return. It's absolutely insane over a 5-year period. So I think playing the long game and sticking with safer, and that's why I also hear the marks here, sticking with safer crypto assets is definitely the recommended path, because there are a lot of people that lose money in crypto, right? Like crypto went up a lot over the past years, but there's still a lot of people that are losing money, because they're like, it's difficult to handle the emotional volatility, and they're always trying to go down the risk curve, meaning searching for lower market cap coins that can do multiples. And I've done that myself in the past. And, you know, there has been this AI coin which worked well, but in the end, I didn't sell. And there also have been meme coins that I put money into, and investing is definitely the wrong word for that. And they fell to like 80% beneath my entry price. So that's usually not the wise path to go. Like if you're looking for long-term wealth, and I think that's what the audience also is of this podcast, you can definitely benefit from crypto if you have a moderate allocation to it within your portfolio and focus on safer, proven assets, right, which have weathered the storm already. You know, like if you think about crypto, if you think about Bitcoin, Ethereum, Solana, for example, like they have had multiple drawdowns also, and they didn't die, right? They always come back. And if you stick with that and you dollar cost average, I think you're gonna massively increase the total performance of your portfolio.
So what do you think the future is for something like Bitcoin?
That's a good question. I think that Bitcoin is never going to be a means of payment. And so like if I try to just be general and then maybe related to the investing side, I think a lot of people see crypto as, okay, like this is going to replace how we pay for stuff and whatever. And like if the McDonald's French fries is going to be priced in Bitcoin or whatever, I really don't think that's going to be the case. I really see Bitcoin more as a store of value. Like it will behave like gold, I think, in the long term, and it's starting to behave like gold from a price action perspective. Like it is not a fully risk-on asset and not a fully risk-off asset, I think, at current times. So I think Bitcoin is going to be a store of value similar to gold in the future, and already is. And I do think in crypto there is going to be some sort of adoption when it comes to payments. Like a lot of payments that you do online, you can already do in crypto, but mostly on through stable coins, basically. So it like that would mean that the technology that crypto has, which is really good, right? The instant transactions, low fees, like that is coming. But I think most people will not realize it when you actually buy something online, that it's probably like that the payment is processed through crypto, right? Payment providers like PayPal and Stripe, they already operate models through crypto, and they're just based on stable coins. And stable coins are coins that are pegged one-to-one to the pound, to the euro, to the dollar. So I think that's where we see the tech. But from an investing perspective, I do think it's more like a store of value in the future, and I don't think that we're gonna pay in Ethereum or Solana or whatever in the future. I think that's probably pretty ridiculous.
So you just mentioned that it's behaving a bit like gold. So for investors, gold is considered a bit of a safe haven asset, but crypto is very volatile. So can you just explain what you mean by that?
Of course. Yeah, like generally, I think in the markets there's always like two investor sentiments, which is called like risk on, and that would mean that basically investors are looking to seek returns in the market, right? So whenever, for example, the US dollar strength goes down, interest rates go down, then there's a lot of appetite for risk in the market. And it's when, crypto and equities usually perform really well. And then there are other times, right, when the dollar strength rises, the yield, for example, on the US dollar rises. So people are looking for safer assets, like if they can get like a 4%, 5% return on government bonds, right? Like why would you put your money in equities? The risk to return is just not there. And that's when risk off assets perform well. Also like during, crisis and stuff, that's when gold usually performs well. And I have seen recently that Bitcoin in particular is behaving like a risk off asset in crypto. Like if you just look at crypto, meaning that if there is fear in the market, Bitcoin is going to drop the least versus all other altcoins. And when there's greed in the market, Bitcoin is going to rise at like the least versus, more risky assets. And if we look at, all asset classes combined, crypto is still the most volatile. And I really don't want to, argue about that. All I'm saying is that I do feel that the volatility, especially of Bitcoin, is coming down a little bit, right? Historically, we have seen drawdowns of up to 75% from the all-time highs to the lows of a 4-year, 5-year cycle. And I really see that this is not happening to the same extent anymore. So it's like I think the better word would be it is like traversing or like on a journey to become more a risk-off asset like gold.
Okay. So in the future, it might become less volatile, and you feel it's on its way there.
Yeah, like also looking at the market cap, right? You always have to think about how much money is needed to move a market. And 3 trillion, right? Like what the total market cap is. And I think Bitcoin is just beneath 2 trillion. It's still a lot, but compared to, other asset classes, it's still so small. That's why, it's volatile, but it's not as volatile as, 5 years ago where, the total market cap was beneath 1 trillion. And, Bitcoin was maybe 500 billion. And that's when a lot less capital is needed to move the market.
Okay, so, I mean, I've heard people say about crypto that it has no sort of intrinsic value, no tangible value. What would you say to that?
So that is a fair concern, right? And it's a question that I hear a lot, and I think the mechanism that I resort to is always trying to reference it to assets that other people know, right? And the same, like what I have seen from other people is that what is the value, let's say, behind 1 ounce of gold. 1 ounce of gold, like gold coin is going to be that big, and it's like $4,500. Like, what is the value? Like why is it worth that much? If you think about 10 years ago, that coin was maybe $1,500. So like it's a 3x from there. So why, like how do you determine the value in the end, right? A market price is a market price because there's equal amount of demand and supply in the market, and I think that goes for all assets. And it's more difficult in crypto and also in commodities, right, to figure out the value, right? In equities, it's quite simple. You just take price to earnings or price to book ratio, right? Like it's more mathematical, right, and more like it just feels more logical. And with crypto, it's just not the case. But that's also why it is more volatile, and also why you as an investor can get outsized or asymmetric returns, because there is no congruent opinion in society how much value it is. And that's like, you might think at first like this is a disadvantage, but if you're investing in it, you have the advantage, because there's always an oscillation between fear and greed in the market and in the world, and between risk off to risk on sentiment. So whenever you invest, you have the asymmetric return if at some points during the market there is an illogical amount of fear or illogical amount of distrust to an investment. So it cuts both ways, right? So there is no universal definition of how much worth a Bitcoin should have, right? It always depends. But you have an asymmetrical return because of that. That's what I always find interesting. It's not necessarily a negative.
From a security perspective, I know a lot of people have concerns around how quote unquote safe cryptocurrency is, it being a digital asset, and there being kind of, examples of hacks being done to the crypto exchanges in the past and people losing a lot of money. So what can you do about that? Like, if you are genuinely considering getting into crypto, is that just an immutable fact that you have to accept, or are there ways that you can try and safeguard your investments?
So, like, short answer, there are definitely ways to safeguard your investment. I think in crypto, there is also an asymmetric amount of risk compared to other assets, right? Because it's just such an emerging industry with less regulation, like more options of what you can do wrong, I think. But if you follow, I think, a few guidelines of risk, then your investments are as safe as in equities, right? So the first step, which I already mentioned, is you need like a broker, a regulated exchange. And if you stick here with one that is regulated, that has KYC requirements, right, that's always a good sign. So meaning know your customer. So you have to like do an identity check via like some phone call or whatever. That's always good. And, that the broker is located in a jurisdiction that also, upholds the law and yet just, feel safe, right? That's important, right? Like a regulated exchange. And that was what many people didn't do, right? Previously, I'm not sure if anyone here on the podcast here heard of FTX, right? Which was one of the biggest crypto exchanges. Like, it was really like a top dog. Like you could see the sponsorships in NFL stadiums and everywhere. So it was really out there. But in the end, it was located in the Bahamas. There was like little to no regulation, and that's what enabled the shady business that they did behind the scenes, right? And that's what caused a lot of investors to lose a lot of money, right? So sticking with the regulated exchange is important. Then what I do see as a positive as well is the regulation, right? Regulation has been a big issue in the past. For example, another crash, which also happened in 2021, it was like a black swan event, which people in crypto call it, is the Luna crash. It was basically a stable coin which lost its value overnight. So stablecoin, again, pegged 1-to-1 to the underlying currency. And it was an algorithm that did the pegging rather than being backed by actual assets. And that is something that the US administration just recently introduced. It's called the Genius Act, which means that stablecoins have to be backed with reserves of the actual currency, either in the currency itself or in treasury bonds, which is really good. So that helps you as well as investors, right? It increases the safety. And I think lastly, you as investors, you should be just maybe that extra bit skeptical of crypto, because if there is someone who promises certain returns, who promises like extraordinary amount of wealth creation, then I would always be careful, right? Like an industry like this, unfortunately, is prone to these types of, influencers, or to these types of people, because it just has a lot of potential, right? And if you and they exploit that potential to lure you in, right? So I think it's always important to be skeptical and not. And always be careful of what you do with your money, right? Like in the end, right? If you control it, that's good. And I would never recommend following someone's advice blindly by like putting it in some fund or whatever that promises a 2x or whatever return every so often. That's most likely a Ponzi scheme, right? And so yeah, like long story short, there are a lot of things that you can do. And I also think from a regulation perspective, it really goes in the right direction, but you still, I think, should be careful with what's going on in crypto. And there's one other thing that I would like quickly to mention is that I do think there's a misconception that oftentimes there are scams where the monetary transactions happen through crypto, but the scam itself is not a crypto scam, right? I'm thinking of pig butchering. I'm not sure if you've heard it. Like there's a lot of YouTube videos on it where basically, do you guys know what it is?
No, please tell us.
Yeah, it's a cruel like it's a cruel name, but basically it is people messaging rich Westerners. And usually those people are either forced labor. It's a very dark scene. Basically, like just messaging them through Facebook or WhatsApp groups, and there are various things, but oftentimes it's love related. So basically, like having a fake profile picture, having a fake name, and then writing someone. Oftentimes it's in the US that hey, this is me and this is my story, and I saw your pictures, and then it's sort of there is an emotional connection that happens, and then there's often a monetary transaction, right? That happens. I can only recommend. There was one recent video from CoffeeZilla. I'm not sure if you know him on YouTube, who went deeper into that. And that was super interesting to know. And that, unfortunately, the payment gateway was through crypto, but in the end, like the scam was didn't have anything to do with crypto. It was just because crypto is just, easier to transact money, right? Because you have those, non-KYC brokers. So you as a scammer, can easily, or transactions are just more easy on that financial system rather than, through a bank.
Well, I think that's really valuable guidance, particularly around just triple checking, particularly if you're in the crypto space, because there are still, I guess, some vulnerabilities that are being worked out. And in the meantime, it's just, really important to double check everything.
I completely agree on that. And, it's a new industry at the end of the day that, hasn't been around 20 years ago, right? The white paper of Bitcoin was written, I think, in 2009. So, it's roughly 15 years, a bit more. And so it's still like a new industry with, not enough guardrails. So I do think, that's going away in the future. But that would, in my opinion, will also result in lower returns overall, right? Because the market is not going to be as volatile. But, in general, if you are a responsible human being and focus on credible resources and maybe not listen to every YouTube influencer, and that would include also myself, right? Because there are just a lot of shady ones. Like I would not maybe sign up for for a broker that is recommended by your favorite crypto guru, because most often they're just not safe, right? It's not a safe option, but that's how those influencers make money at the end of the day, right? They make money with the biggest amount of commission, which which they get from the least regulated platforms, obviously. And there, I would just recommend to be careful, but that shouldn't deter you from, capitalizing on crypto and start allocating it to your portfolio, right? Like I think with that, like it's a new technology, but it is proven that it's going to be around. Just looking at the market cap and the institutionalization with ETFs being introduced, right? That's also a great way, by the way, how you can invest. I'm not sure about the UK if there are ETFs on Bitcoin already, but that makes it just easier because you can access it through your equities broker, and that just reduces the friction even more to owning assets in crypto.
I do have a slightly, it might be, a slightly off the cuff question, but when crypto was first introduced and, started gaining a lot of traction, there was a lot of talk about, the decentralization of just another way of doing financial transactions and things like that. I guess over time, with the introduction of like so many coins, and now we have those stable coins and everything like that, are we just seeing things become a bit more centralized in a different way? And if that does happen, what would make crypto so different from just, equity investing?
That's a great question. Yeah, I think decentralization is a big part of the crypto identity, right? Like in the end, a blockchain is decentralized. There's no single authority who owns the blockchain or who basically can manipulate it. If you want to, think about that sort of thing. So it's always decentralized, meaning that every transaction is validated by a decentralized network of validators who get remunerated in the currency of the blockchain, right? So that could be Bitcoin, for example. So there is deep identity root within decentralization. But it does have benefits, right? It is transparent, and you don't rely on a single entity, right? If your local bank does, like if your local bank lends out the money to some shady person, right? And if your deposits are over the state insured limit, right? Then you are potentially also in trouble, right? Because your custodial is not taking care of his duties, right, properly. So I think in that sense, like transparency and decentralization is definitely something that I would love to see more of. And also is super good to see, right? Also, like as a quick detour in crypto, there is an ecosystem called the decentralized finance ecosystem, where basically there are a lot of digital banks which facilitate lending, borrowing, and so on and so forth. But like the key difference there, what I love personally, is that I can see the assets of the digital bank and can exactly see what they're doing, and can see how much collateral there is, and that just reduces your risk that much more, in my opinion. But I do think that there's a limit to decentralization where some centralized guidance and also regulation makes sense. So I am a fan of the decentralized aspect when it comes to transparency and security, but I think it only works if there is an equilibrium also to centralization and to regulation in the end, because our world is a regulated world, and if you leave it unregulated and completely uncentralized, you're going to be in trouble at some stage.
So, Markus, if somebody wanted to find out more about crypto from you did mention that you have a YouTube channel. How would they find you?
You basically just type in Markus Lutz in the YouTube search bar, and then you would find me. I'm also on Instagram and LinkedIn.
You better spell that surname for people. And your first name, because it's not Markus how the English spell it.
Oh yeah. It's Markus with a K, so Markus, and Lutz is Lutz.
Amazing. We'll make sure we link to it in the show notes.
Appreciate it.
Markus, thank you so much for joining us today. This has been a really interesting chat, and it's been great to dig into another side of investing.
Yeah, it's been very educational for me, because I actually didn't know an awful lot about crypto beforehand. But it's probably something I'll probably have a look at, having spoken to you.
That sounds amazing. Then I've done my job, and it has been truly nice to talk to both of you, and very interesting to hear your questions. And I really hope that I could provide some value. And I'm thankful for the exchange that we had.
Thank you so much for joining our Investing Insiders podcast. If you liked the episode, please subscribe and leave us a 5-star review on your platform of choice. For the latest money news and deals, you can sign up to our weekly newsletter at investinginsiders.co.uk/newsletter-page. We've also got a suite of guides, tools, and calculators on our website at investinginsiders.co.uk. You can also keep up to date with us on TikTok, Instagram, and YouTube. Thanks for joining us, and we'll catch you in the next episode.